billionaire and hedge fund manager Howard Marks, author of The Most Important Thing, Common Sense for Thoughtful Investors. His objection was to provide the book that represents his investment philosophy to an average investor, and I believe he was extremely successful to achieving his objection, and I'm going to share some of his profound ideas in this video. His first important idea is the second level thinking. You have to think beyond the obvious. The first level thinker sees the favorable circumstances and decides to buy. The second level thinker sees the investment is overhyped and too expensive to provide margin of safety. On contrast, the first level thinker sees unfavorable circumstances and decides to sell. The second level thinker sees the investors have panicked and driven the price to the bargain level and buys. Next big idea is to understand market efficiency and its limitations. While it is true many markets are fairly efficient most of the time, but they are not always efficient. Investors who choose to believe the market cannot be outperformed leave the inefficiency for those who are willing to be second-level thinker. Understanding market inefficiency is very important, so you can recognize the biggest opportunities. The most important thing is value. Marx talks about the difference between growth and value. Growth is bet on the future, but future is uncertain, therefore you may be paying for something that does not materialize. Value is more consistent. Paying 50 cents for $1 is a lower risk than guessing what will happen in the future. The best value is when you can buy growth at the value price, but that may not be always available. Relationship between price and value is caused by investors' psychology that leads to a stock price to be mispriced. In the short run, investing is more like popularity contest. The most dangerous time to buy an investment is at the peak of its popularity. At that time, all the positive data and assumptions are reflected in the price. Everyone that is going to buy has already bought. The most optimal time to buy an investment is when no one else wants it. At that time, all the negative data and assumptions are reflected in the price. Everyone that is going to sell has already sold. Buying the price way below the intrinsic value of the investment is the most reliable approach to making investment profit. Another important idea is that you have to understand risk. There are several misconceptions about risk. Riskier assets don't necessarily provide higher rates of returns, otherwise they wouldn't be riskier. Risk does not come from weak fundamentals, because almost any investment that bought at the right price can be a profitable investment. Risk does not come from volatility, but risk comes from how the investor reacts to volatility. Risk can be reduced if you follow these two steps. 1. Making an accurate assessment of the real value of an investment. 2. Making a sound decision based on the relationship between price and value. Investments that are overpriced should be avoided or sold. Investments that are underpriced are candidates to be purchased. Risk is actually the highest when everyone believes risk is low. This is because investors beat up the price of an asset to the point it really is risky. At the high price, favorable outcomes have low expected returns, and unfavorable outcomes can result in large losses. On the other hand, risk is lowest when everyone believes that risk is high. This is because investors have reduced the price to the point it's no longer risky. At the low price, favorable outcomes have the highest expected return, and unfavorable outcomes result in smaller losses. Investors should recognize that risk comes with the price and not the quality of investment. High-quality assets can be risky and low-quality assets can be safe. It's just a matter of price you pay for them. Another important thing is to pay attention to cycles. Cycles have a way of being self-corrected. Reversals don't necessarily need outside events. They reverse on its own. Success creates the seeds of failure, and failure creates the seed of success. Most of the times, investors decide the trend will never end. When times are good, they conclude the trend will continue upwards forever. When times are bad, they talk about downward trend that will never end. Don't assume the trend will continue forever. Instead, be aware of possible major turning point. Another thing, you have to know what you don't know. Forecasts about economy and future twists and turns in the stock market are dangerous. and probably worthless in the long run. Pay attention to valuations, balance sheets, and income statements, and last to economic forecasts. Have a general idea of what the valuations are in terms of cycles, but don't try to forecast something that we don't know. And finally, you have to be confident in your analysis. You have to have a courage to stay disciplined when price varies from your valuations. You must be strong enough to overcome the powerful psychological influence that will attempt to get you to join your consensus. So this is the end. Once again, the name of the book was The Most Important Thing by Howard Marks. I would recommend this book to any investor out there. It's very philosophically based. I really enjoyed reading it, and I hope you guys enjoyed this video, and thank you guys so much for watching.